I spoke to 3 people yesterday, each at different debt fund platforms, and all of them had either folded or they'd consolidated.
There's a lot of parallels between the credit side and the equity side. As you're seeing debt funds fold and consolidate, you're seeing syndicators also kind of going under or out of business.
I think there was a tremendous amount of money raised for distress. A little bit of it deployed, 75 to 80% of it didn't. And it's got 2 options. It either sits idle or it begins looking at JV equity opportunities. I'm a big believer that one creates his own luck. You can't control the macro. You cannot control what deals close and what deals don't close. All you can control is how hard you're working, who you're reaching out to, and if you're giving it your all. That's it.
Amen. All right, welcome to another episode of Deal Flow Friday. I'm your host, David Moghavem, and today we got Zach Streit, founder and president of Priority Capital Advisory. Priority Capital Advisory, if you don't know, providing debt and equity capital solutions for middle market and institutional commercial real estate. Zach's been in CRE for 20 years, starting on the principal side, then on the lending side, and for the last decade in the capital advisory side, prior to starting his own firm and his own capital advisory platform. So, Zach, you're a big name in the industry. Welcome to the pod. Great to have you, and great to finally meet you in person on a couple of days ago. So, at CREFC. So it's good to have you on.
No, thanks, David. It's great to be here. Big name in the industry, I don't know, but somebody with the hairline to prove that I've been at it for a long time for sure. And it was actually awesome to meet you at CREFC. And I'm actually sad I'm back in LA, which is generally a nice place to come back to, and that we couldn't be recording this live, but next time, hopefully.
Exactly. Any excuse to kind of come back to Miami is a good excuse. Definitely bummed that we're not doing this live. It's always a little bit more fun to banter around in the setup I have here in the office. But good to have you here, and it was fun at CREFC too. It was a madhouse. I mean, it was crazy being there.
Yeah.
A lot of people, a lot of buzz. I think half of it just because everyone wants an excuse to come to Miami, but I feel like there's
January. Most of the country is like craving Miami then. So
and I
it
think
always
some
gets
people,
a good crowd.
and people were probably let down a little bit that it was a little bit gloomy and rainy that day, but there was some energy there. I'm sure you felt it, and I'd love to get your take first of all. Like what was kind of the vibe that you got from it? What was the key takeaways from CREFC after the back-to-back meetings that you had?
Sure. So I probably had 20 or 25 meetings. We try and pack them in and make sure that we're talking to all manner of lenders there. I think the biggest takeaway is probably a continuation from a theme in the debt capital markets that really started last year. And that is not a little more capital than deals, but a lot more capital than there are deals. I think this was underscored by when banks really came into the market, probably second or third quarter last year. They really reemerged, and they reemerged making cheap loans direct to borrowers, and they reemerged back levering debt funds more aggressively than they had previously. That's caused compression in the market. It's caused increased competition. You are hearing just about, further compression and spread. You are hearing about more leverage. You are hearing about, decreased debt yields, both in place and stabilized. And like, it's a little bit of a race to the bottom. It's still relatively new, so I don't think it's as frothy as it was in, 19 or 21. And, the macro picture probably isn't as frothy now as it was then. But from a debt capital market standpoint, there's a lot of money out there. Part of this too, and I think this is interesting, is that there's, I think, been the rise of insurance companies backing transitional lenders, which is a newer trend in commercial real estate historically. And you learn this in your finance classes. Insurance companies are generally, 7, 10, 15-year fixed rate long-term lenders. All of a sudden, you have insurance companies backing transitional lenders, both bridge and construction, in a pretty significant way. And so that's just, in addition to banks, another liquidity pool entering, I guess, commercial real estate and backing debt funds and causing
Do you
some of
think
the
that's
competition there.
sorry to cut you off. You think that's
Sure.
just because they can find some extra yield there, an extra spread?
100%. I don't think it's because they can. I think they need to. I think,
Hmm.
between keeping up with the annuity products they offer their clients and just their insurance liabilities, I think putting money out at 5 and 6%, while great, probably isn't enough to meet their needs. And so I think, similar to commercial real estate investors and their search for yield, I think insurance companies are on a search for yield also. And I think they found something that they like. Now, unlucky for them, yield today on transitional products, and we can talk about this in more detail, are probably 200 to 300 basis points less than they were 18 months ago due to a mix of spread compression and also rate cuts. But look, we closed a construction loan year end that was through a debt fund that I know is backed by an insurance company, and it was an 8% loan. And there's no way you're going to get 8%, on a long-term permanent loan. So you can see immediately the arbitrage and why they would be kind of in the space. Last thought on CREFC, and I don't know if this was an aberration or if this is a trend. I spoke to 3 people yesterday, each at different debt fund platforms, and all of them had either folded or they'd consolidated. Now, this is something that I'd wondered about for a long time because for probably 2 years, plus or minus, we've been reading about the golden age of private credit. So said Steve Schwartzman and John Gray at Blackstone. We'd seen this just tremendous proliferation of debt funds. And I started to wonder, like, is this sustainable? Like, how many and for how long? And it was interesting that, not one, not two, but 3 different people from 3 different shops said, hey, our shop had either folded or consolidated and, we're now out looking for something. So look, that may be something to watch and, maybe a gentle plug to the sponsors out there to use a broker or me. They just say, like, you need to know who you're getting into bed with out there. While capital is plentiful and while, non-recourse debt fund capital is plentiful, they are certainly not all made equal. And the guy that's here today might be gone tomorrow. And, should that happen during the course of a transaction, that can be like potentially very damaging. So it's just something to, watch out for generally in terms of an industry trend. But I think it's also something to just watch out for while you are in a transaction. Make sure that you're with somebody who's, here to stay, playing the long-term game, has discretionary capital, probably isn't a newer outfit, and just has longevity, has staying power. I think that's the key to many things.
Yeah, there's a lot of parallels between the credit side and the equity side. As you're seeing debt funds fold and consolidate, you're seeing syndicators
Hmm.
also kind of going under or out of
Yeah.
business or trying to just put out fires and liquidate whatever they can and get rid of the dogs and save some assets that are still salvageable.
Right.
You're also seeing that the credit side can be almost an indication of what the equity side on can be, as you're seeing spreads compress and capital flows going into credit and yields getting tighter. What's next on the capital stack on the equity side or pref equity? And so it's
Yeah.
a domino effect. The credit that they can't find their yields, they start coming into hybrid, pref equity products. The pref equity mez guys start getting into common equity, and those capital flows result in compressed yields in the marketplace.
I think you're right. So, to be clear, 90% of what I do is as a debt broker, and I would include preferred equity and mezzanine financing in activity as a debt broker. But 10% of the activity that I do or deals that I work on are deals where I'm helping sponsors place JV equity, not syndicating, but with, call it single source equity capital providers that might write a check between, let's say, 7 million and 25 million. And there has been an uptick, at least in interest. I don't know about closed transactions,
Right.
but from people in that space. And I think it has a lot to do with what you just said. I think there was a tremendous amount of money raised for distress, rescue, mezz financing, preferred equity strategies over the last few years. And I think some of it, a little bit of it deployed. And I would venture a guess that 75 to 80% of it didn't, because I just don't think we saw distress on a grand scale during the correction of the last few years. And it's got 2 options. either sits idle or it begins looking at JV equity opportunities. And I
Right.
think, I guess I'm a big fan of the Blackstone guys, but they said earlier that, hey, we think the deal dam breaks in 26. And I think what they meant was, hey, you've got cheap debt available in the marketplace, primarily from banks, but also to some degree from debt funds. That was missing over the last few years. And rate cuts are a real thing. We've had about 200 basis points in Fed funds rate cuts. And so now, as opposed to in 22 and 23, when you were sort of staring at the barrel of rate hikes, you're now staring at the barrel of rate cuts. So that and cheap debt are powerful. They don't solve all the world's problems. I don't think deal flow explodes overnight, but they are two pretty powerful instruments, powerful themes that just weren't present in the marketplace, call it, 18, 24 months ago, and they are now. And I think that combined with the lack of distressed opportunities is forcing more folks to turn and to look for common equity opportunities. Now, to be clear, I don't think the spigot for common equity and development opportunities is all of a sudden turned on. I think that
Right.
continues to be a very challenged place. But the spigot for common equity into value add opportunities, multi-industrial, some degree retail, and maybe for gamier providers office. I think that's interesting again. And we're seeing it, in our flow. And I think that, we typically will close 2 to 3 equity deals, these types of placements every single year. I hope we at least do that this year, but I am getting hit up more than normal for people trying to find equity capital solutions. And on most of the deals we market, we are getting stronger responses than we did 1 and 2 years ago. So I think you're absolutely right. And I think the arc is generally positive.
One thing to add there, I feel like a couple years ago when we were all anticipating the wave of distress, these institutional partners that are now you're saying asking for common equity opportunities or interested, they had a whole plan of putting out pref equity out there with
Yeah.
mid-teens return. But there was a little bit of a pitfall in the strategy because most of these groups would try to pitch 80% of the stack or 85% of the stack and have a sponsor come out with the rest of the 15 subordinate to that pref equity to rescue the deal. The problem is there's not a lot of operators out there, A, with the liquidity and B, with the conviction to be behind that when you're subordinate to a slug of capital that needs a mid-teens return. That's good. That could be good money after bad for a common equity provider, right? Still a good deal for the pref equity, but you're stuck. You're not solving the whole problem for that sponsor. So what happened? A lot of that equity didn't get put out. And as you said, Zach, they need to put this money out now. They need to put that money to work. They're seeing on the credit side, the spreads start to tighten, SOFR also coming down, and it's a race to the bottom, as you said. Once that hits bottom, you're going to start to see that back into the common equity side. And so I do feel like this year, at least, we have NMHC in a couple of weeks, and 2 years ago, everyone was pitching their pref. Every equity provider was pitching their
Right.
pref. I don't know if everyone's going to be pitching their pref this year. I think it's
Yeah.
A, people are tired of pitching the same thing for the past 3 years, but B, I feel like the smart ones at least know what's next and that you're not going to get your return being 80% of the stack for pref. You got to take a little bit more risk if you want to hit that return. And so that's what you're hearing, that some of these groups are now interested. Are they in line with market yet? Not necessarily. I think there's still some time, and I think these sellers still need to meet the market and capitulate to kind of get to those returns that work for that cost of capital. But you're seeing that bid-ask spread start to tighten a bit.
Yeah. I think everything you said is right. I would add one thing. Another reason the pref that was expensive didn't deploy in 2022 through 25 was banks extended and pretended a lot of deals. And they did so either without a common equity injection or just with a small one. And in many cases, not all, that common equity injection was made just by capital calling the existing equity. And in a lot of cases, those capital calls occurred. I worked on numerous deals that I thought would be right for third party pref because they met that distress profile, but somehow sponsor was able to blend and extend, pretend and extend, and if it had to, make a small capital call and make a token pay down. And then now enter an era where rates are on transitional products 200 to 300 basis points lower because of rate cuts and spread compression, and an era where you can talk about financing multifamily, which I guess is the benchmark, at a sub 5% rate with a buy down. And now there's a debt way out of a lot of those problems. So you're right. So where does the money go? It has to move back onto the equity side, and we're seeing it. And for sure, there's still a bid ask. The untrended return on cost, the benchmark for multi typically being around a 7, is still very, very, very hard to manufacture. And I think
Oh yeah.
most sellers have not capitulated to that point yet. But there is a moderation that's happening. And I think both sides are going to have to give a little bit in order to get deals done. But I think we're much closer to that now than we were. So it should be a fun year and an exciting year, as I think we see equity creep back into the marketplace.
Yeah, I hope it's a fun year. It's been
Me
it's
too.
been a lot of false starts the past couple of years. One more thing to touch on this, we
Sure.
talked a little bit about transitional borrowers, and we've been focused a little bit more on type of recapitalizations or rescue. But from what I see, there really hasn't been too many acquisitions that are being executed with bridge. And I feel like part of that is because from the fundamentals, at least in multifamily, there isn't enough conviction in upside to justify buying with bridge. And the risk adjusted return on putting something like expensive bridge on a deal that operationally you don't have conviction is going to go up doesn't really justify buying bridge, and maybe a lot of capital is not as as comfortable to taking bridge. Is that also kind of what you're seeing, where maybe some of these spreads are tightening to do deals, but it might not be as much on the acquisition side, or are you actually seeing these start to happen in acquisitions and borrowers might be going back to old habits?
Yeah, no. So all great questions. So a few points. First, acquisition activity is coming back, but it's muted relative to what it was. It still feels like it's way down, and I think it's way down because of the bid-ask spread that we just kind of touched on. Second, with respect to bridge financing, I think you're right. You're not seeing bridge financing predominantly on acquisition deals. Where you're really seeing it is lease-up deals, construction takeout deals,
Right.
and then some bridge to bridge deals where people just need additional runway. I think third, the reason you are seeing more fixed rate agency and otherwise activity on acquisitions is, I think, two reasons. Number one, you can get a fixed rate below 5%. And I just think generally there's some sort of psychology out there where if you're at 5 or significantly, let's say, above it, you might go bridge because you feel like on a long-term basis, hey, like north of 5, I don't know, doesn't feel
Just
great.
from a gut, from like a
Just from a
10,
gut level. Not
past
even
10 years in the industry, like gut below 5 feels good, above 5 feels expensive.
100%, just licking your finger, putting it in the wind. But I think that's the psychology. And now that the dam broke and you can get to 5 or below, I think that's a lot more attractive. I think the second part of the thinking really has to do with how a lot of folks got burned with floating rate that was either not capped or limited cap exposure. So I think you could do a bridge deal if you had, sort of a 5-year cap on it, which you could purchase, or maybe a 3-year full term cap on the initial term. But I just think there is a lot of heartburn over that strategy because of what happened to folks when rates ran up. On all of the construction deals that I've been working on and some of the bridge, guys are doing at least 3-year caps so that they're capped all the way through the initial term, thinking that would be sufficient. And it probably is. But again, This is just psychology. This is just people reacting to what they've seen recently. And so I think those two forces of low fixed rate availability, now that the 10 years moderated somewhat from its, high in like the fives, um, to fear over what is unlikely to happen anytime soon, but what could happen if interest rate hikes were to start again. I think that's pushing people more in the fixed rate direction.
Yeah, and it'll be interesting to see how that might shift, right? There's talks of new Fed chair and they're going to be a little more hawkish and do a few more rate cuts. Rate cuts really affect SOFR, but is it going to cut treasuries too? We saw that like a year or so ago, where there was a 50 bip cut and everyone thought that bonds will rally and it did the opposite. And I think with treasuries, the fear of deficit matters, the fear of inflation, runaway inflation still matters. And so that stayed kind of sticky. But it would be interesting if they do cut and treasuries do stay sticky and higher, if people maybe just go back to bridge saying, hey, I can get the same exact rate for something transitional than something fixed rate.
Great point. So I think what you're saying, big picture, is that greed always settles in, or the rational, mathematical, scientific mind settles in. And you're
Right.
absolutely right. Like, you're dealing with SOFR that's 350. But what if SOFR goes back to 200? And then you have a spread of 250, which is where a lot of multi deals are getting done, on top of a SOFR rate that's 200. Now you're talking about a floating rate that's 4.5% all in, starting to feel like 21 again. You cap that for 3 years and you have a 4.5% fixed rate for 3 years. That absolutely could move people back in the bridge financing direction, especially if you can only get fixed rate financing at, say, 5% today, or maybe 4.5 or 4.75 with a buy down. Like, people may just not want to incur that and the yield maintenance that goes with that. They may want to preserve optionality because their view may be like, hey, fixed rates shouldn't be 4.5 or 5% if SOFR's, at 2%. Now, there is a relationship between the short end and the long end of the curve, but as you alluded to, it's a complicated one, and it doesn't always move in lockstep. And just because the Fed lowers rates dramatically, even from where they are, doesn't necessarily mean the longer end of the curve moves. It's governed by a different set of rules: supply, demand at buying treasury, future potential for inflation, so on and so forth. And so, yeah, if there's a big sort of delta, then arbitrageurs are going to jump in and they're going to take another side of the bet. I think that's absolutely true. We've seen it before. There's no reason we shouldn't see it again.
Yep. And I could see how you get a bridge loan that's 3+1+1 or 4+1. Instead, you want to be responsible. So instead of the 3-year cap, you go 5 years and say, okay, I learned from my mistake. I'm going to cap it longer. And that rate cap probably costs pretty similar to what a buy down would be to be sub five, and justify to do it. And you get a little bit more leverage. And so I do feel like this is a year where, if the Fed does cut enough, but treasuries still stay a little sticky due to some of the systemic issues of the country, you could see that trend. You could see people actually kind of going back to bridge. So will be very, very interesting to
You
see
could
in
be
that
right.
regard.
It'll be
Yeah.
interesting to watch.
Yeah. So Zach, I want to shift a little bit. You've worked on a lot of deals, a lot of complex deals. You actually just closed a $175 million construction and land recapitalization loan in Santa Maria, which for California, that's massive.
Thank you.
So couple of things. One, I would love to hear a little bit about the deal itself. This is obviously a huge milestone for you, for Priority Capital.
Yeah.
So would love to hear a little bit about the deal itself, about how this kind of feels for your company as well, as this milestone, and go into some of that.
Yeah. Well, I very much appreciate the question, and I would start by saying that I feel just very, very grateful that I even got to work on a deal of this size, let alone close it. It's the second largest in my career. So I've closed a $400 million loan prior to this, but it is the largest since I started Priority Capital about 20 months ago. And no question, I hope that it sends a message to the marketplace that I have a long history of closing large transactions. I just closed another one, and hopefully sponsors that are working on larger scale deals, which I really consider, call it 50 to 200 million, will think of me, particularly ones that have some hair, need some storytelling, and really need somebody to lean in. Um, so that's my little commercial. In terms of the deal itself, yes, it was a $175 million loan that I closed. It was an interesting one. It was for the first phase of a master plan development. So the loan facilitated the vertical development of 300 units of ground up multi, which let's say is a medium hard thing to do. But what was very difficult was there was an additional 85 acres of entitled but vacant land that was part of the collateral. For structural reasons, in terms of how the equity was deployed, it was impossible to separate the two. So anyone that was going to make this loan needed to not just make the loan for the vertical multifamily, but also needed to recap the land. The land was bought peak of the market, so that made it hard. To offset some of the value degradation, the sponsor very shrewdly densified the master plan, added another 500 units, so it's a total of 1,500 units, and added some optionality where some of the parcels that would have been built to rent or multifamily got re-entitled for sale, which I think is a very smart move. And you're seeing this strategy across the industry broadly because for sale housing has held up despite higher rates better than, call it, for rent development housing. So against all that, the financing mandate was, go out, do this, raise money so we can build the first 300 units, prove our thesis, and recap the land. Took me probably a year to get this done. I remember CREFC a year ago. We brought the sponsors out and we had 25 meetings with them. I tried to get the same table again this year. They wouldn't give them to me. I'm like, hey, that's good karma. And it just shows you the power of in-person meetings and the power of perseverance. We actually had this deal apped and we were close to closing it 5 months ago. And we had a big lender retrade, which resulted in us having to go out and find a new, I should say, mezzanine lender. So there were actually two lenders on this deal. There was a senior construction lender and there was a subordinate debt lender or a mezzanine lender. The first mezz lender that unfortunately we have to deal with retraded us. It was a major institution and unfortunately they claimed they didn't have the capital for it, which was crazy. And, frankly, when that happens, it's a precarious place to sit as a broker in a transaction. But the client was very loyal and kind of very understanding. And so we went back out and not 2 weeks after that retrade, I'm proud that I was able to procure another sub debt offer with a lender that ultimately closed the deal. And it was actually for more proceeds than we had initially. Part of that is my hustle. Part of that is it was a lender that we met with back in January a year ago that at the time he just, I guess, didn't see the value in the same way that he did later. The market kind of thought. And part of it is just luck. And, it's better to be lucky than good. But that lender ultimately closed on the transaction in a relatively seamless fashion. And I'm excited. The sponsors are now going to be able to, get the thing built, prove their thesis. And Santa Maria is a great market. It's almost like the Texas of California. It's had a ton of growth, unlike many other markets in California, which have been under pressure. But there's a real story, Vandenberg, SpaceX, and, also the land or that area being kind of a bedroom community to Santa Barbara and a sort of feeder into the Central Coast wine country, which is, becoming a bigger and bigger industry. So there's a lot to like about the transaction. It certainly had its challenges, but I think that's an example of where somebody like me can be, I think, really effective in terms of just not giving up, remaining optimistic, leaning in and telling a story that ultimately resonated and now lets the project move from dirt into something else.
First of all, credit to you.
Cool.
I mean, to be at it for over a year to get this through the finish line is in this choppy environment is truly a testament to your hard work, and credit to you on that. And big milestone, and I'm sure there's way more to come. One
Yeah.
of the things that you mentioned was, it was a little bit of meeting and luck. And I feel like part of that luck you've really created yourself by going back to CREFC and the 25 back-to-back meetings you have. And you were even telling me, hey, between NMHC in a couple of weeks and CREFC, I have another conference that I'm going to. And hey, before CREFC, I was at another conference. And, talk to the audience a little bit about why you hit every single conference there is to hit and why you do the 25 meetings a day and what's the benefit of that, because I really do feel like end of the day the luck is something that you've created for yourself. So talk a little bit about the audience on that power.
Thank you. No, I appreciate it, and I agree with you. I'm a big believer that one creates his own luck. I think for me, uh, even though we're doing this digitally, I'm a big believer of the in person, especially when you're a broker
If you just
and you're
stayed
doing.
another day, we could have done this in person. But
If I didn't have two young kids at home,
yeah,
that are 7 and 5 and that go to miss their dad, and I wasn't already gone for 3 days and 2 nights, but I will make it up to you. We will do it. Part two of
perfect.
this will be in person. You have my word. I'll figure out a way to do it. Maybe I'll
I'm
take the
in.
whole family to Miami for a little vacation.
Sounds good to
Well,
me.
as a broker, especially as a debt broker in a crowded market, you're selling trust. You're selling trust that you're going to hustle more than the next guy, that you have a strong understanding of the capital markets, which is the debt capital markets, which is an ever changing landscape. And I think it's pretty hard to do that if the sponsors don't see you in person. And so that's a real reason I try and remain as visible as I can. And I go to all the conferences I can. I'm not JLL. I'm not Newmark. I have no aspirations to be. I love the white glove boutique intimate service that we provide our clients. I'm also aware that I don't have a many tens of millions of dollars marketing budget behind me. And so, how do you offset that? You sell yourself. You get in front of people. You let them know that you're meeting, with the sponsors, with their competition. You're meeting with all the debt capital providers. You're meeting with all the equity capital providers, because a big part of my business is making intros to sponsors, to equity providers to help them grow their business. And I won't lie and also say that the equity capital sees you hustling. Two things come from it. Number one, equity capital will make intros for you to sponsors, and some of my best clients have come through that, because my gosh, if your money partner is telling you to use this debt broker, you're probably going to listen. And number two, sponsors feel more comfortable coming to me where they have an equity capital provider pre-identified in their deal and knows me. And the only way of staying in front of those guys and meeting them is making sure that you're going to all the conferences you can. I also work across geographies and across product sectors. So I pretty much cover nationwide geographies, except the Northeast, which I think is too overbrokered. Certainly very dangerous, Colorado, Texas, and West, but I'm refining an office bridge deal in Indianapolis. We just launched a spec industrial deal in of all places, Charlottesville, kind of outside Richmond, in Virginia. And you can only get that business and that reach, if you're kind of constantly out there and constantly in front of people. So, it's kind of end where we began. It's a big part of creating your own luck, but it's also about visibility and selling trust and giving people an example of your hustle, a white glove service, and the intimacy of it, that you really care. There's, part of being a boutique, and you guys are pretty big, but this to some degree, is there's nowhere to hide. Right?
Yep.
It's my name on the door. It's nobody else's name. We don't have investment sales, so we aren't kind of handed deals, and my name is on the package as consulted that guy. It's kind of very naked brokerage. Priority Capital is, but I like that, and that motivation, that type of relationship that it conjures, has really served me well over the course of my career. It's a very entrepreneurial thing, and I'd say a lot of my sponsors, not all of them, a lot of them are either entrepreneurs themselves or have a very strong entrepreneurial streak. It's generally those types of guys that want to work with me, and vice versa. I find them inspirational. Maybe they do me too. Now that I really have my own shop with my name on the door and nobody else, I have no outside debt, no outside investors. And so, yeah, this is all part of creating your own luck, creating a structure that sort of aligns with entrepreneurial shops where they'll want to use you, where they know that I'm a killer for my clients, that there is nowhere to hide, that there is no safety net, that I'm out here pushing the envelope as hard as I can every single day.
Yeah, and actually, the first time I've heard that term, naked brokerage, and you said it when we met a few days ago, and saying it now. I guess to wrap up, what does that term really mean to you? And in that context, what is some advice for people in your shoes looking to get into the brokerage and capital advisory side and call it, naked brokerage?
Sure, we make quite a term here. When I say naked brokerage, I mean brokerage that kind of doesn't have investment sales, isn't attached to a larger company, and really sort of lives by the sword and dies by the sword. Now, don't get me wrong. If you're a broker at a bigger shop, there's a lot of pressure on you too, and you only eat what you kill. I think for me, also adding to it that I have my own platform. So unlike most brokers, they cannot make money, but I can lose money. I've got a team of 5 people, and they are compensated base and bonus, not commission based. They're execution only. They help me get big and hard deals done, small ones too. And I've got a monthly obligation, a monthly liability every single month. So if I'm not closing, not only do I not make money, I lose money. So I think, that's part of what I mean by that in terms of being naked and being aligned. With that said, I've got some partnerships too. I do a lot of agency work through Walker and Dunlop. I do some insurance company correspondent work through a company called Slat. These are relationships born over years, tend to work very, very well. And so, I don't like have no mouse traps in the arsenal, but it's less than you would at a larger shop. My advice to young people who are starting, I think brokerage generally is a wonderful place to start. You see the landscape of who's out there and what's out there. You see how deals are made, kind of, how the sausage is made, so to speak. And then you kind of have a unique purview where, if you work as a debt broker, you're primarily focused on debt, but you see how some equity deals get done. You see what the sponsors have to go through to raise that equity. You see how the sponsors are compensated. You see how the sponsors maybe entitle a project, execute a business plan. So it gives you an amazing purview. You see almost all sides of the business here. So I encourage people to start. I wish I started here. I went to B school and brokerage was a bit frowned on, and I bought into that for a while. And I often wonder if I didn't buy into that and I had started here, like, where would things be? Not saying I'm unhappy. I'm thankful for my background, but I absolutely encourage people to start. Now, whether you want to start at a big shop or a small shop, really depends who you are and where you want to go. I did 5 years at 2 large shops, and I am forever thankful for that time. I learned from some very smart, very polished people. And part of me misses that, but it isn't who I am. It's just not in my DNA to be in a big corporate environment. And I think this one suits me. And so a lot of it is about, do you know yourself? And if you don't, try a small shop, try a large shop. You have the advantage of trying things when you're young to figure out who you are and where you're going to fit in. So I absolutely endorse brokerage. I endorse big shops and small shops, depending on who you are and what you want. Bigger shop, you probably see larger deals out of the gate and, I don't know, maybe cleaner stuff. Smaller shop, you work on a lot of middle market and maybe smaller deals. They'll be less clean. They'll be more entrepreneurial. So it just depends, what exposure you want. There's no right or wrong way to do it. Really just depends what appeals to you. And remember, where you start is not necessarily where you finish. My
Right.
first job was for a Fortune 100 insurance company. That's about as big as it gets. And here I am, a smaller 6-person shop, but hey, we pumped out 600 million last year and 800 million, in 20 months since inception. And I'm really proud of that. So, also trust your gut a little bit. It's okay to try.
Yeah, I actually, to caveat what you were saying, I actually started in capital advisory as an intern at George Smith Partners, probably while you were there.
My alma
So
mater. Good stuff.
yeah, so
Love it.
as you said, it is a nice place to start. Learn the lingo, so you will.
Yeah.
and getting a good mentor. Shout out to Steve Stein, by the way.
Okay. Yeah. Small
And
world.
But you're right. It's a good way to get your feet wet. And I think end of the day, just keep on working hard and having the work ethic. You'll end up in the right place, big or small shop. So, and
That's
that's
all you can do.
yeah,
You can't control the macro. You cannot control what deals close and what deals don't close. All you can control is how hard you're working, who you're reaching out to, and if you're giving it your all. That's it.
amen, amen. Well, Zach, great having you on the pod again.
Thanks,
Looking
David.
forward to linking up at one of these thousands of conferences. And thanks again for hopping on.
Yeah, my pleasure. Thanks for having me.